Financial statements play a critical role in modern financial markets because they provide standardized information about a company's financial performance, position, and cash flows. Investors, creditors, regulators, and analysts rely on these reports to evaluate profitability, risk, liquidity, and long-term sustainability. Financial reporting allows market participants to compare companies across industries and time periods using a consistent accounting framework. According to the program, the role of financial statement analysis is to use accounting information together with other relevant data to make economic decisions regarding investment, lending, and valuation. Effective financial reporting therefore enhances market efficiency, transparency, and investor confidence in capital markets globally. The primary financial statements include the income statement, balance sheet, statement of cash flows, and statement of changes in equity. Each serves a distinct purpose in communicating financial information. The income statement measures profitability over a period by reporting revenues, expenses, and net income. The balance sheet presents the company's financial position at a specific date, including assets, liabilities, and shareholders' equity. The cash flow statement explains how cash is generated and used through operating, investing, and financing activities. Together, these statements provide a comprehensive picture of business performance and financial health. Analysts combine information from all statements to assess operational efficiency, solvency, liquidity, and future growth potential in a consistent analytical framework. Financial statement analysis is essential because raw accounting data alone rarely provides sufficient insight. Analysts interpret reported figures to evaluate trends, profitability drivers, risk exposures, and earnings sustainability. The program emphasizes that analysts use financial statements to assess a company's past performance and current financial position in order to forecast future profitability and cash generation. Common analytical tools include ratio analysis, common size statements, trend analysis, and cash flow evaluation. These techniques help identify strengths and weaknesses within a firm's operations and capital structure. Investors may use this analysis to determine whether securities are undervalued or overvalued, while lenders evaluate whether borrowers can meet debt obligations and maintain adequate liquidity. Regulatory filings and accounting standards are fundamental to ensuring the reliability and comparability of financial statements. Standard-setting organizations such as the Financial Accounting Standards Board, FASB, and the International Accounting Standards Board, ISB, establish accounting frameworks including US GAAP and IFRS. Regulatory agencies such as the SEC enforce compliance with these standards to protect investors and promote transparent markets. The International Organization of Securities Commissions, IOSCO, also supports consistent global securities regulation. Regulatory requirements improve confidence in financial reporting by requiring accurate disclosure, independent audits, and management certifications regarding internal controls and reporting quality. These mechanisms help reduce fraud risk and improve market discipline. Financial statement notes and supplementary disclosures provide critical detail that cannot be fully conveyed within the primary statements themselves. Footnotes explain accounting methods, assumptions, estimates, legal contingencies, pension obligations, segment performance, related party transactions, and significant events occurring after the reporting period. Analysts often rely heavily on these disclosures because they clarify the quality and sustainability of earnings. For example, segment reporting enables analysts to evaluate the profitability and growth prospects of different business units separately. This allows more accurate forecasting and risk assessment. Supplementary disclosures also improve transparency by helping users understand management assumptions and the uncertainty surrounding reported financial results, which is particularly important when evaluating complex multinational firms. The statement of cash flows plays a unique role because it focuses on actual cash generation rather than accrual-based accounting earnings. Analysts use cash flow analysis to evaluate whether a company's operations generate sufficient cash to sustain the business, repay debt, fund investments, and meet unexpected obligations. High-quality earnings are generally supported by strong operating cash flow, while persistent differences between earnings and cash flow may indicate aggressive accounting practices or earnings management. The cash flow statement also highlights financing decisions and investment strategies that may not appear clearly in the income statement. By examining relationships among operating, investing, and financing cash flows, analysts gain deeper insight into a company's financial flexibility and long-term sustainability. Financial statement analysis also helps identify risks associated with poor reporting quality or biased accounting choices. Management may intentionally manipulate earnings to meet market expectations, maintain stock prices, or avoid debt covenant violations. Aggressive accounting methods, earnings smoothing, and misleading disclosures can distort economic reality and reduce the usefulness of financial reports. Analysts therefore evaluate reporting quality by assessing accounting policies, unusual transactions, non-recurring items, and consistency across reporting periods. Independent audits, strong corporate governance, and effective internal controls help improve reporting reliability. However, even audited financial statements require careful interpretation because accounting standards permit significant managerial judgment and estimation in areas such as asset valuation, revenue recognition, and contingent liabilities. Ultimately, financial statements serve as a bridge between companies and capital market participants by communicating economic information in a structured and comparable form. Effective financial reporting supports efficient capital allocation, informed investment decisions, and stable financial systems. The program emphasizes that analysts must not only understand accounting rules but also interpret the broader economic implications of reported figures. Financial statements are therefore more than historical records. They are essential analytical tools used to evaluate performance, estimate intrinsic value, forecast future cash flows, and assess business risk. A strong understanding of financial statement roles enables finance professionals to make sound decisions and contribute to more transparent and efficient global capital markets.